Welcome to our latest video, where we'll explore how to build a diversified investment portfolio. As an expert in finance, I'm excited to guide you on this journey and share my knowledge on various investment options, such as cryptocurrencies, stocks, real estate, and more. Building a diversified portfolio is crucial for long-term success in the world of investing, as it helps spread risk and capitalize on opportunities in different market segments. With a well-rounded investment strategy, you'll be better equipped to weather market fluctuations and grow your wealth over time. Before we dive in, please remember that I'm not a financial advisor. These videos are for educational purposes only, and investing of any kind involves risk. While it is possible to minimize risk, your investments are solely your responsibility. It is imperative that you conduct your own research, as I am merely sharing my opinion with no guarantee of gains or losses on investments. As we explore these topics, you'll gain a deeper understanding of how to create a well-rounded investment strategy that suits your personal goals and risk tolerance. So let's dive in and unlock the secrets to building a successful diversified portfolio. One of the foundational steps in building a diversified investment portfolio is assessing your risk tolerance. This is a crucial aspect of investing, as it determines how comfortable you are with the potential ups and downs of the market, and helps you make informed decisions about where to allocate your funds. Risk tolerance can be broadly categorized into three levels: conservative, moderate, and aggressive. To determine which category best fits your personality and financial goals, consider factors such as your age, financial situation, investment goals, and time horizon. For instance, if you're young and have a long investment horizon, you might be more inclined towards an aggressive approach, as you have more time to recover from potential losses. On the other hand, if you're nearing retirement, you might lean towards a conservative strategy to preserve your capital. It's important to be honest with yourself when assessing your risk tolerance. You don't want to be caught off guard by market fluctuations that make you anxious or lead you to make impulsive decisions. Take the time to evaluate how you might react to various market scenarios and whether you're comfortable with the level of risk involved. There are several online risk assessment tools and questionnaires available that can help you better understand your risk tolerance. These tools can provide you with a starting point, but keep in mind that your risk tolerance may change over time as your financial situation and goals evolve. Regularly reassessing your risk tolerance ensures that your investment strategy remains aligned with your current financial objectives and comfort level. Another essential step in creating a diversified investment portfolio is determining your investment goals. Having a clear understanding of what you want to achieve with your investments will guide your decision-making and help you stay focused on your long-term objectives. Start by identifying your financial priorities, such as saving for retirement, buying a home, funding your child's education, or building an emergency fund. Each goal may have a different time horizon and require a different investment strategy. For instance, short-term goals like building an emergency fund may be best served by conservative investments, while long-term goals like retirement planning may allow for a more aggressive approach. Next, consider how much money you'll need to achieve each goal and the time frame in which you'd like to accomplish it. This will help you understand the rate of return you'll need to generate from your investments. Keep in mind that higher returns often come with higher risks, so it's essential to strike a balance between risk and reward that aligns with your risk tolerance. Once you've established your investment goals, you can start building a diversified portfolio tailored to your specific needs. And remember, it's crucial to monitor your investments and adjust your strategy as needed, to stay on track towards achieving your objectives. Don't forget to like this video and subscribe to our channel for more expert advice on building a diversified investment portfolio and other financial topics. Your support helps us continue to create content that empowers you to make informed financial decisions. A key aspect of building a diversified investment portfolio is understanding the different asset classes available to you. By spreading your investments across various asset classes, you can reduce risk and increase the potential for higher returns over time. There are three main asset classes: stocks, bonds, and cash. Stocks represent ownership in a company and offer the potential for significant growth, but they also come with higher risks. Bonds are debt instruments issued by corporations or governments, providing a steady income stream with generally lower risk than stocks. Cash and cash equivalents, such as savings accounts and money market funds, are the safest and most liquid investments but typically offer the lowest returns. In addition to these main asset classes, you can also diversify your portfolio with alternative investments like real estate, commodities, or cryptocurrencies. These assets can provide additional diversification benefits, but they may also come with unique risks and challenges. Understanding the characteristics and risks of each asset class will help you make informed decisions when building a diversified portfolio that aligns with your risk tolerance and investment goals. So, keep watching to learn more about how to combine these assets effectively and achieve a well-balanced investment strategy. Strategic asset allocation is essential for building a diversified investment portfolio that meets your goals and risk tolerance. This process involves deciding how much of your total investment capital should be allocated to different asset classes, such as stocks, bonds, and cash. One popular approach to asset allocation is the rule of thumb called the age-based allocation. This method suggests that you should subtract your age from 100 and invest that percentage in stocks, with the remainder in bonds and cash. For example, if you're 30 years old, you might allocate 70% of your portfolio to stocks and the remaining 30% to bonds and cash. Keep in mind that this is just a starting point, and you should adjust your allocation based on your specific risk tolerance, financial goals, and time horizon. As you get closer to your investment goals, you may want to gradually shift your allocation toward more conservative investments to protect your gains. Remember that asset allocation is not a one-time decision. Periodically review and rebalance your portfolio to maintain your desired allocation and ensure it still aligns with your goals and risk tolerance. Selecting the right investment vehicles is crucial for a diversified portfolio. Your choice should align with your investment goals, risk tolerance, and time horizon. There are several types of investments that can help you achieve your financial objectives. Stocks allow you to own a share of a company, providing the potential for capital appreciation as the company grows. Bonds are loans you provide to corporations or governments, offering regular interest payments and typically lower risk than stocks. Mutual funds and exchange-traded funds, ETFs, pool investors' money to invest in a diversified mix of assets, providing instant diversification and professional management. If you're new to investing, consider starting with low-cost index funds or ETFs. These investment vehicles track a specific market index, such as the S&P 500, and offer diversification with minimal fees. As you gain experience, you can explore individual stocks and bonds or actively managed funds that aim to outperform the market. Remember, it's essential to research and understand each investment vehicle before adding it to your portfolio, ensuring it aligns with your financial objectives and risk tolerance. Regularly rebalancing your portfolio is essential for maintaining your target asset allocation and managing risk. As different investments perform differently over time, your initial allocation may shift, causing your portfolio to become more or less risky than desired. To rebalance, you'll need to periodically review your investments and make adjustments to bring your portfolio back in line with your target allocation. This may involve selling some assets that have performed well and using the proceeds to purchase others that have lagged. A simple way to approach rebalancing is to set a schedule, such as annually or semi-annually. Another option is to rebalance when your allocation deviates by a certain percentage from your target, such as 5% or 10%. Rebalancing not only helps you manage risk but also encourages a disciplined investing approach. By selling assets that have outperformed and buying those that have underperformed, you're essentially selling high and buying low, which can contribute to long-term investment success. Monitoring your investments and adjusting as needed is a crucial part of building and maintaining a diversified investment portfolio. As an investor, you should regularly review your portfolio's performance to ensure it stays aligned with your financial goals and risk tolerance. One way to stay on top of your investments is by setting up a routine, such as checking your portfolio quarterly or monthly. This allows you to spot trends and identify any areas that might require adjustments. For example, if an investment has consistently underperformed, you might consider replacing it with a better performing alternative. Keep in mind that personal circumstances can change over time, which might necessitate adjustments to your investment strategy. Events like marriage, having children, or nearing retirement can significantly impact your financial goals and risk tolerance. Be prepared to reevaluate and modify your investment plan as your life evolves. In summary, building a diversified investment portfolio involves assessing your risk tolerance, determining your investment goals, understanding different asset classes, allocating your assets strategically, choosing the right investment vehicles, regularly rebalancing your portfolio, and monitoring your investments to make adjustments as needed. By following these steps and staying disciplined, you can create a well-rounded investment portfolio that is tailored to your unique financial needs and objectives. Remember to subscribe to our channel and hit that like button for more informative content. Thank you for watching, and we'll see you in the next video.